So if you're able to look at the market several times a day, you're probably either, maybe you're retired and you just don't want to be chained to your desk, or maybe you're a computer-based worker, you're quite busy, you have a few business meetings perhaps, you find yourself not really able to look at a 15-minute chart in case you get sacked by your boss or something like that. Then obviously choosing the right time frame is very important. You probably want something a little faster to move than the daily chart, because you can make a few more decisions throughout the day. But you're the type of person who can probably look at the markets 2, 3, 4 times a day: breakfast, lunch, dinner, evening, that sort of thing. And you're going to be looking to take trades off maybe a 60-minute chart or a 4-hour chart. Good time frames, really. 4-hour charts in particular, we use them a lot, of course, for the trend analysis on our intraday 15-minute charts. The difference here between trading off longer term charts to 15-minute charts or day trading is that you're going to be in positions for longer. Typical duration might be a day to 3 days, so you're going to have to hold positions overnight. The markets you trade a little bit more diverse, really. You can trade a few more different FX pairs, all the ones from the previous market slide, but also perhaps some different crosses, so the likes of Euro Aussie, Euro CAD, Sterling Swiss, that sort of thing. So the major economies against each other, basically. So it just throws open quite a few different markets there. And of course, because you're not looking at the markets quite so much, you're able to look at the charts on a 4-hour chart, make your decisions every 4 hours, do some analysis, and probably look at a larger number of markets. Instead of looking at half a dozen markets, perhaps you might be looking at 2 dozen, maybe. Depends on how long you have throughout the day, those little pockets of time that you have to look at the markets there. Depends on how many you might want to look at, but certainly 10, 15, 20, 30, if you have the time, looking through those slightly more longer term charts if you want to. Of course, we can look at more markets because the spread is less of an issue. When you're trading off a 4-hour chart, obviously the targets, the stops are going to be a little bit wider. So if you're looking at a 100-point target, you don't have to be looking at markets with a 1-point spread or a 2-point spread. You can probably open it up a little bit more to some markets with a 3 or a 4-point spread. It's much less of an impact on your trading account. So slightly more medium spreads perhaps, not really wide stuff. You don't want to be trading sort of Norwegian krona or anything, but certainly something like the major economies, your Swiss francs, your sterlings, your dollars, that sort of thing, your euros. You want to be trading those sorts of markets against each other for those sort of low to medium spreads there. Remember your risk sizing on this though, everybody, because what you are going to have to do is have wider stops on these markets compared to a 15-minute chart. It may perhaps be that you'd be more comfortable trading with a broker that allows you to stake less than £1 a point. Now that may sound a little bit rubbish, but remember, you need to be risking an amount of money you're comfortable with on the trade. So if you end up with a 75 point stop and you only want to risk 50 quid on the trade, you can't do that if you have to trade £1 a point or above, because the minimum you can risk on that trade with that broker is then £75. And you really do want to be doing those trades. So the problem with certain brokers is if they limit you to no less than £1, it means one of two things, or one of several things really. You're either going to do the trade anyway and put the stop tighter than where it should be and probably get stopped out. You're either going to do the trade anyway and put the stop where it should be and risk too much money on the trade. Okay, so we're risking 75 quid instead of 50 in this example, which is not really ideal, because that trade has therefore a much bigger impact on your account. It's almost like implying you're 50% more confident that that trade's going to be a winner, which you're probably not. Or alternatively, you think, dash it all, I just won't do the trade at all. So one of those three things, none of them are ideal. So you may find that you will need to trade at a place with a slightly lower stakes, but there are brokers there in the trading account section of our website that might be able to offer a little bit of assistance there, and we have our own team that can help you there as well, obviously. So certainly wider time frames means slightly wider stops, means lower stakes, but also because of the bigger targets just opens up our ability to look at a few more markets there. Still big markets, still big currencies, still big commodities, but just a little bit more flexibility than day trading.